Many people I've spoken with lately have told me about how they are buying houses for appreciation. This is a huge mistake in my opinion. I believe within the next 3 to 5 years, these individuals are going to get burned badly. Now, I have always liked residential real estate as a cash-flowing hard asset. Real estate is in my blood. Since I was young, I was attracted to it and understood it well, which drove me to buying my first rental property at age 18. As a young man, I was buying in the late 1990s, at the very start of the real estate bubble. Living in Southern California at the time, I was easily seduced into forgetting about cash flow and becoming a full-time speculator whose only experience was price appreciation, which is exactly what investors are experiencing right now. Long ago, the real estate market was taken over by the government with the introduction of the 3-decade loan. Unqualified buyers receiving government backing, and of course the government-sponsored enterprises introducing the low-down, no skin in the game mortgage. This fueled real estate prices higher for decades, and when that slowed down, the Federal Reserve kept the party going with low interest rates. Today we have a serious problem in the real estate market. When it comes to prices where the majority of Americans live, residential real estate is a house of cards. Here's a chart of a 10-year Treasury note. Let's do some math on home affordability in the future with rising interest rates. Since they're already at rock bottom levels, they can only go up. With a $300,000 mortgage note with the standard 3-decade loan, here are the payments. 4.5% interest rate gives you a monthly payment at $1,520. That's current rates. At 8%, which is the 1990s norm, that gives you a payment of $2,201. At 19%, which is what we saw in the early 1980s when we saw a spike, that payment would be $4,766. Prior to 2003, rates below 5% were unheard of. So today's buyer is completely disconnected from a normal interest rate environment with rates at just over 4% in 2014. Realtors and salespeople across the country will often cite the 2006 highs in proving to you the potential for further price appreciation. But we should remember that from 2004 to 2006, subprime loans exploded in their growth, which won't happen again so close to the 2008 bust. The stated income loans, no documentation loans, and the 1% option arms are gone. So is the secondary mortgage market for that matter, at least for the foreseeable future. FutureMoneyTrends.com believes that the upside for further gains in real estate, specifically California, Nevada, Arizona, and the Northeast, is very limited, perhaps another 10% over the next 18 months. However, beyond that, the downside is huge. As interest rates rise, we expect to see a 30 to 50% price decline in some of these inflated markets, especially in places like Arizona and Nevada, where an unusually high number of investors have swarmed those areas looking for flipping opportunities. Our recommendation is to buy houses for cash flow or become an investor who adds value to a property in order to make a profitable sale. Don't get caught in this house of cards, because when this bubble bursts, it'll be far worse than the last one. Real estate bubble 2.0 will see rising interest rates due to the Fed's loss of control. So there will be no rescue this time or soft landing. It will be absolute blood in the streets. What will drive the rental boom? No money for a down payment, no driver for jobs, bad credit due to bankruptcy or foreclosure, unqualified due to lack of income and high debt levels. This is not the coming rental boom. This boom is happening right now, and as you can see, the underlying fundamentals are very supportive. Apartment vacancy rates are down to 4.2% according to research by Reese. Prior to the housing bust, vacancy rates were above 8%. For single-family homes, the median asking rent just hit an all-time high in July of 2013. According to the National Association of Realtors, 5 to 6 million families will become new renting households in the next 10 years. Renter households have jumped from